Okay, folks, here we are. Zoopla UK House Price Index for May 2023, just right now. So this is hot off the press today. Zoopla have announced a research and insight into the UK House Price Index for May 2023. It gives a real good indication about how they see the perceived housing market and where it's going and what's going to be happening. So we're going to go over some of the data. I'm going to show you some of the charts as well. Do take a quick sip. Some of the charts as well. So the executive summary so far is UK house prices have actually fallen, according to Zoopla anyway, at 1.3% over the last 6 months. Okay, why are they saying 1.3% over the last 6 months? Because they don't really want to take the 12 months because it probably won't suit their narrative, because it'll mean that house prices are probably still gone up. So got to take that with a pinch of salt, haven't you? Because they're now saying it's 6 months. Anyway, rate of price falls has slowed as activity levels recover. Stronger growth in new sales brings more sellers into the market. What they're basically saying there is an oversupply. Above average activity in the northeast and also Scotland and also London. Weaker demand, but sales hold up in the Midlands and southern England. Regional trends explained by recent price inflation and affordability. Mortgage regulations have tempered the impact of the higher mortgage rates on house prices, and the prospect of higher mortgage rates in the second half of the year is likely to weaken demand and activity, but the scale depends on how the rates will move itself. Let's look at a wee chart here and see where we are. Okay, so right across the board, you can see there, price falls. Let's talk about that, what they talk about. In the last 6 months, but pace falls. House prices and the housing market activity continue to adjust to the impact of higher mortgage rates and rising living costs. The Zoopla's UK price index has registered a 1.3% decline over the last 6 months. And in recent months, the rate of monthly price falls has slowed as buyer confidence implodes, buyer confidence improves. Implodes. That's a complete opposite. So buyer confidence improves. Sales also increased in response to falling mortgage rates and a strong labour market. The labour market still remains extremely strong. Therefore, that's what's propping up the economy and keeping things going right now, because there's still amount of money and supply in the actual housing system and also in the money supply chain. There's things eating away at that, obviously, the cost of living. Inflation's eating away at that level as well. Interest rates are going up and eating away at that level of earnings as well. So there's pressure from all sources which are contributing to a slowdown to a degree, slightly, in the housing market and a stabilisation overall. So we're not getting a boom, we're not getting a bust. It's more or less a stabilisation, I would say. So what they go on to say as well is they expect prices to remain broadly static for the rest of the year, as I've said. However, higher than expected inflation data has increased the probability of interest rate rises further. That is no surprise. Inflation is obviously the key primary target of the Bank of England to actually curb under control. And the only way they've got to do that right now is actually to curb, it's actually to increase base rates in order to increase interest rates, in order to take some of the money demand out of the supply chain, and actually for people to cut back on what they're spending. Therefore, inflation will come down as a natural result, because it's a supply and demand system the way it works. Underlying trends for inflation as well has actually shown that in the services sector especially, the inflation is still quite high in comparison to food inflation, which apparently is actually beginning to come down ever so slightly. But it is coming down where services industry is going up. So that's why you get the 8.7% inflation from the 10.1, because these other factors are influencing it, as well as in July, the cap for energy prices will be reduced. I think it's from about 2,450 to round about the 2,000 level. It doesn't mean to say every household will pay that. It just means their costs should actually decrease as a result of that, which will put more money into supply again, which possibly could fuel inflation again. That's why they're concerned. So more sellers as market confidence slowly improves. Here we go. So here we are. Despite weaker demand, the number of newer sales improves. So here's the demand here. So more sales and new supply despite below average demand. This is the percentage change over the 4-week period compared to the same period between 2018 and 2022. And it's the resale market only. So demand has actually dropped by 14% in comparison on average. Number of sales agreed has actually increased ever so slightly. Flow of new supply has increased quite dramatically as well. And the stock of new homes for sale at 10% more than that period as well is increased as well. But then that takes out the demand coming down and the stock going up, takes out the boom market overall. Okay, so they go on to say, Zoopla goes on to say about this chart, despite weaker demand, the number of new sales agreed over the last 4 weeks is 11% higher, as you can see there, than the 5-year average of the same period. That's quite interesting because you would expect it, but if there was less demand down here, that the number of new sales agreed would be actually less as well, but it's actually 11% higher than the 5-year average for the same period. As many buyers are also selling, most sales boost the flow of new homes for sale, which is up 16% on the 5-year average. While there are more sales being agreed, sellers must remain realistic on pricing and attract buyers' interest. Some 18% of homes currently listed for sale on Zoopla have had their asking price cut by 5% or more compared to the 28% in February. Price reductions typically come 8 weeks after the first listing as sellers try to boost their interest from the buyers. So after a couple of months, that's when you tend to find that sellers become more realistic about their pricing strategy, in the English market particularly, because they don't have home reports, so they don't have an accurate account. They just put a figure in place judged by the estate agents, and then they work from there about whether supply and demand will take over that. Whereas we have home reports in Scotland, and that tends to be the base level where everybody starts, and theoretically, and most of the times, people will pay slightly over the home report value, if not a bit more, or just under the home report value. So it's not big, huge swings like the English market. Okay, let's have a wee quick look at the next one. Annual growth in sales across momentum, across all factors of all areas. So we'll just take a look at that. Now, this shows you the annual growth loses momentum across all cities. See that there? There's the in the purple there, annual price change April 2022 up there. And annual price change April 2023 is a lot different overall. And that's where that backs up that area. Now, this is actually quite a good one as well. Landlord sales add to the availability of supply. This is really interesting, actually. Landlord sales actually add to the ability of supply according to availability of supply, according to Zoopla. So some landlords looking to rationalise their portfolios in the face of higher mortgage rates and legislation are also adding to supply. Some 1 in 10, that's 11% of the homes listed for sale, were previously rented out, a level that peaked at 14% in 2020 and which has drifted lower over the last 3 years. So it's starting to go up again. 5 years ago, around half of these homes returned to the rental market as unsold or bought by another investor. However, this proportion has dropped to a third more recently. These ex-rented homes have asking prices that are 25% lower than the owned homes. That's 190,000 versus 250,000, and will appeal to first-time buyers. So there you can see it there. There's the sales agreed and the demand. So regional view on the demand and sales agreed. You can see in Scotland there, the sales agreed is really, really high, and the demand is actually quite low in comparison. But if you look overall, demand is quite low, but you can see in the other areas, demand is really low. So in Scotland, actually, that market is actually quite good in terms of the landlord sales and availability of supply. There is actually more first-time buyers in Scotland than has been in a long time, especially Fife itself, and less landlords. And that's primarily because more landlords are exiting the market in Scotland because of the draconian legislation put in place by the Scottish government. It tends to be influencing it quite a lot. So let's talk about that a wee bit more. There are some distinct variations, according to Zoopla, in the market strength across Great Britain. Buyer demand and new sales continue to perform best in Scotland. Yep. And the North East and London, demand is above the national average in these regions, and sales are more than 10% higher. Demand remains below average in the English regions and across the South and the Midlands areas, where house prices posted some of the greater gains over the last 3 years. So higher prices together with the hit to buying power from mortgage rates, higher mortgage rates, and increased cost of living have taken more buyers out of the market in these areas. That's because in the areas of England, there's a higher price point. So therefore, and we tend to find the average salary across the whole of the UK is almost about the same, except for when you go to London. So that's why the average salary isn't able to buy as much in the English market, hence the reason why demand has dropped so dramatically in comparison to Scotland, which is still extremely affordable at an average price point about around 190,000 to buy a house in Scotland, which is almost just about 6 times the average salary. Now, when I say average price point for a house, that's not a first-time buyer house. That tends to be a house when people upgrade to, or people actually downsize to. So that's why that average price point. So you're not expected to jump in and buy a house as a first-time buyer at 190 grand. Technically in Scotland, it's probably round up to about 100 to 110,000 as a first-time buyer property. So no sign of any build-up in unsold inventory. So that's good news, because transactional numbers are really encouraging for the health of the property market overall in the UK. There's no sign of any build-up in unsold inventory. In other words, there's no build-up in homes that haven't sold for a long time. They tend to be at the upper end of the market, though, in terms of the 500,000 upwards. In terms of Fife itself, I don't know how that is across the whole of Scotland and the UK, but I imagine it would be when it's the upper regions, because there's weaker demand for that. So while demand is weaker and supply is rising, Zoopla finds no evidence of any material build-up of any unsold stock of homes. The number of homes listed for more than 90 days in most areas is in line with the 5-year average, which is very encouraging for the health of the property market. It suggests that while new sellers will need to set asking prices carefully, there's no need for larger price falls to clear stock at this stage. So the prices are not going to fall anytime soon, according to Zoopla. So take that on board if you're thinking of buying and you think I should maybe hold off to see if I can get a better deal. It's probably never going to happen anyway in the short term, or possibly even the medium term. So just be aware of that. Let's jump on to the next one and talk about this graph next. Now, this actually shows the wide variation in house price inflation over the last 7 years through the different areas. You can see that there. Earnings growth over the last 7 years is 30%, but you can see the wide variation in terms of that, where they are. London hasn't moved up significantly, but proportionally in monetary terms, a 10% rise in London is about £50,000, whereas a 10% rise in Scotland is about £19,000. So that's why Scotland tends to be a lot higher in terms of that, in terms of 28% rise over the last 7 years. And you go into East Midlands, and that tends to be around about 45% rise over the last 7 years as well. You can see there, and that's straight across from the index and the base 100 right here. That's why you get the difference there, with earnings growth up at 30%. So it tells us in Scotland, earnings growth has actually grown higher than the average price point in Scotland. So Scotland still remains very, very affordable, if not more affordable than 7 years ago, because earnings have increased more than Scotland. Same with the southeast region, same with the northeast region, and same with the London region. If earnings growth has gone up 30% in London, and property prices have only really gone up in that time in terms of just under 10%, then there's a huge difference here in terms of where affordability. Anyway, let's move on then and see what Zoopla's got to say. So they said, as I said, would-be buyers and higher mortgage rates. It also has increased in the sensitivity of the would-be home buyers and higher mortgage rates. House price growth for the last 7 years has ranged from 12% in London to 47% in Wales. The average earnings has increased by 30%, as I said. Areas in the house price growth outpacing earnings aligns with those that are in demand is below average at present, in contrast to the regions in the countries which is the lowest rate of price inflation since 2016 are recording stronger activity. London is not an affordable market, by the way. The average house price is 2 times the UK level. However, Low price inflation has improved affordability. There is better value for would-be buyers in the London area, especially those looking to buy flats where prices are unchanged since 2016. Increased migration into the UK is likely to be supporting the market activity in London overall itself. So the question you've got to ask then, the question we've got to ask ourselves is, has the market avoided the risk of a big price correction? And I'll say that again. Has the market, the housing market, avoided the risk of a big price correction? Well, let's talk about that. According to Zoopla, UK homebuyers have seen significant increase in borrowing costs in the last year, which would historically have led to house prices falling. The impact of higher rates has been less pronounced than it might have been in the past due to mortgage regulations introduced by the Bank of England in 2015. This was the stress testing. Anyone taking mortgages since then has had to prove to their bank that they can afford a 6.5 to 7% mortgage stress rate, even though they were paying 1 or 2% at that time. It's as if the housing market, it is as if the housing market and the ability to buy with a mortgage has been operating at 6 and 7% rates already, because all these people that bought in 2015 and onwards had been stress tested at 6.5 to 7% anyway. So the likelihood is the 1.3 million people coming out of fixed rate mortgages, while they think they can't afford the new mortgage rate if they come out of the fixed rate mortgage and they can't afford the new mortgage rate maybe at 6%, they've been stress tested at that level already. It possibly could be that they'll just have to rein back on a couple of things, on things that are possibly classified as luxury items at this point in time, like the upgraded holiday, like, for example, the several nights out a month, and rein back on that a bit. Now, that will affect these industries overall. But there is a way around that as well. For people that are coming out of fixed rate mortgages right now, you should be speaking to your bank way in advance. Even if you're coming out the fixed rate mortgage in 6 months' time, speak to your bank now, because it's going to be a higher rate you're probably going to experience. And they might actually be able to give you a better deal now if interest rates are predicted to rise again. And you might be better off actually taking that hit for maybe an early redemption penalty, which is maybe a few £1,000s in comparison to having to get to the end of 6 months and then have to pay a higher rate mortgage, even higher than it is right now. Also, if you're then thinking, I need to sell my house, the entry and exit costs of selling and buying might be far greater, will more likely be far greater than probably the redemption penalty. So it might mean actually it's worth actually considering that now with your bank. But speak to a mortgage broker about that, because they'll be able to take you through that whole scenario and tell you what you should be doing. So they go on to say that, Zoopla goes on to say, this is one of the key reasons we have seen less of an impact on pricing thus far, but values remain sensitive to mortgage rates rising above 5%. Most lenders are currently testing affordability at greater than 8% mortgage rates right now, hence below average demand and fewer sales over 2023. So the next question you've got to ask yourself then is, what is the risk from mortgage rates edging up higher? Well, let's discuss that. The Zoopla goes on to say the increase in housing market activity this year is down to every mortgage rates falling back towards 4% in line with the underlying cost of finance. The latest inflation numbers has increased the likelihood that interest rates may need to rise further to cool inflation, which means an increase in mortgage rates in the near term. Improving levels of housing activity over the last 2 months prove that 4% to 4.5% mortgage rates are generally manageable for new home buyers. This is despite them being more than double the lows of the late 2021s. However, higher living costs continue to erode spending power at the same time overall. Zoopla's assessment remains that the mortgage rates of 4 to 5% are consistent with house price growth of about +2 to -2, and approximately about 1 million sales a year. So that tends to be where we are right now. So as long as we continue to see a strong labour market, that should maintain at that level. The more mortgage rates move above 5%, the greater the impact on buying power, and the more house prices will come under downward pressure. Bank increasing their affordability test further than the current levels for new borrowers will compound this pressure overall. No doubt about that. Banks really have a supply of mortgage funding at the current rates, but some lenders have also been chasing business with very competitive pricing, meaning rates for best deals are actually set to rise overall. Borrowing costs look likely to edge higher in the coming weeks. How much actually really depends on the financial markets and their assessment of the outlook for short-term interest rates. They've been talking about that in the media and the news today. In terms of most financial markets are predicting interest rates and new mortgage deals are having to go up. There's been about 800 mortgage products currently pulled over the last week out of the market. Now, there's a lot of mortgage products on the market. There's about 3,000, 4,000 products on the market anyway. So 800 is not a lot, but they've only been pulled so the people that have pulled them off can actually then assess their current position and then put new products back on in their place. So it's not the case that they're not restricting, and it's not the case like the credit crunch where they're trying to restrict the market and say we can't lend to you anymore. They're just going to reassess the 800 products and they're going to put them back on at a different level or different circumstances, different criteria. So they will be introduced again. Don't worry about that. So the net result is the build-up of the market momentum this spring is likely to weaken in the second half of the year with the scale of the impact depending on how much the borrowing costs actually increase overall. Quickly, we'll just finish off with a couple of examples of what's the price inflation in the areas. You can see that right across the UK itself. As we do, I'll put off that wee ticket. Actually, I could scroll there if I zoom in. I could zoom in there and you can see right across Scotland. So you can see 2.1% across Scotland. Now, this, instantly enough, is the index over the last year. You notice how I started at the beginning, and Zoopla actually said over the last 6 months, house prices have actually dropped by fallen by 1.3%. Well, they've actually gone up overall in the UK over year on year by 1.9%. So I think that's just a scare tactic to make everybody nervous. So you can see right across Scotland over the last, broken that down for the 1.9 over the last 12 months. In Scotland, it's still, house prices have gone up 2.1% since last year. Northern Ireland up 0.5%, Northwest, everybody seems to be up all the way around. London's the only one that's gone down, but ever so slightly, 0.2%. It's nothing in reality. So it gives an overall picture of a healthy housing market and stabilisation of prices. Quickly jump on to the average price in areas, according to Zoopla. According to Zoopla's figures. So the average price itself, you can see that, average price to buy properties. United Kingdom overall, according to Zoopla, is 260,000. 20 city composite is 296,000. So that's right across the United Kingdom. But they take the cities and it's 296,000. So it's a bit more. But it's still year on year inflationary. I mean, compared to April 2022, you can see there, the UK is actually still going up 9.6%. From 2022 April. So that's actually quite revealing as well. And then 7.8% on the cities itself. So there's mixed messages overall here in terms of the housing market, in terms of what they're actually trying to say. But the reality is it will still maintain, it will still keep going. Okay. So that's it. Hopefully that's given you a good insight. Edinburgh there, 267,000, London, 523,000. And Aberdeen's gone down as usual. So hopefully that's given you a good insight into the housing market overall. And that's me. If you've got any questions, please feel free to ask later on. If you're putting in the comments, please feel free as well. And until next time, guys, I'm Jim Parker for Fife Properties.